All right, so for this video, we're going to talk about FIFO, cost of goods sold, using a perpetual method. So we're doing perpetual FIFO. And recall that when we're applying a perpetual method, we don't want to let forward-looking information bias our analysis. So when we're looking for the cost of goods sold that was at January 10th, I cover up the forward-looking information because this is all we know at the day of the sale when we have to record FIFO. On January 10th, I sold 1,000 units. Once again, I want to just remind that yes, we would have this cash if it was a cash sale or accounts receivable if it was a credit sale. We would record sales revenue for the amount, but I don't give you sales price or if it was cash or credit, so we can't really fill that in. But just as a placeholder, understand how we record COGS using Perpetual. It comes right after on the same day as a point of sale. So I'm looking for the 1,000 units. Now, before when we applied this to perpetual, we had to get that average price per unit, but we don't need the average price per unit anymore. We're assuming that the oldest inventory was sold first. So basically, I start allocating units. Now, if I have 1,000 units that I need to allocate because I sold 1,000, I want to start at the oldest units that I purchased, which is my beginning inventory. I bought these in a prior period at some point. They carried over to our current period, but these are certainly the oldest things that I have in my inventory. So I'm going to assign all 200 of those units. Their price point goes in first as the first thing sold. Then I step forward. These are the next oldest things I have. And now I need 800 more units to meet my sale of 1,000. So I'm going to take all 800 and I have enough. Make sure that you don't just consider all of the units, but only the units kept. But even when I think about just the units I kept here, it's 1,030. So it's more than enough to fill this in for 800 units at the average price per unit of 834. So then I just do the math for that, take the two products. More difficult product, had to calculate. This one is $1,400. So the cost of goods sold of the 1,000 units, right, with 200 of them being assigned a $7 cost from here, and the other 800 being assigned 834 there, comes out to 8,072. But that's just for the January 10th sale. But that's my COGS and my inventory. Now we go forward to the end of the period, the next sale on 130. And on that date, I sold 500 units. We'd have a sales entry, and then we come in with our cost of goods sold. So if I sold 500 units, I want to sell the oldest things first. Definitely not the 400 here, not the 350 here, because we still have some units remaining from the January 8th purchase. We didn't sell through all 1,030 that I kept. I only sold through 800. So the oldest things that I still had in my inventory, I still had 230 units of those. And how did I get that? It's the 1,030 from the 110 purchase that I kept minus the 800 that I just allocated as sold. And that gives me the 230 at that price point that's still in there. And those are my oldest units because I bought them on January 8th. Again, I use the same price point, 834 a unit, but I still need to allocate a price to more units. I sold 500. I only have 230 allocated so far as a cost. So I need 270 more. And I can take all of that from my next oldest inventory, which was bought on January 25th. There would have been 330 units kept here and multiply that by the 923. So I take these two products, and then add them together. And I get $4,410.30. This is my second cost of goods sold entry on January 30th, 44.10, 30 cents, 44.10, 30 cents. Reducing net income, reducing assets. Okay. So we're always going back to our oldest inventory. And you just have to remember that, for example, don't mess up and think, oh, at this point of sale, the oldest inventory is January 25th, because there's still some units in January 8th that we didn't sell through, because when we applied that, we only sold through 800, which left 230 still at that price point. That's how you can kind of get tripped up when you're applying it. So just be aware of that. Again, we can come up with our total cost of goods sold by just adding those two amounts. So the cost of goods sold amount I would drop there would be the 8,072 plus the $4,410.30. And that is 12,482 and 30 cents. It's my total cost of goods sold. You get the ending inventory, I could go two ways, and let's just kind of explore those two ways. The first way would be to acknowledge, all right, under FIFO, I sold 270 of these. You got to be a little careful because remember, there were only 330 kept. So if I sold through 270, then there's 60 left there at the price point of $9.23. And my newest layer was left unsold under FIFO. So all 400 are there at a price point of $10.30. And remember, there was no shrinkage in this problem, so that is not something we have to worry about. That's 4,120. I add those two guys up, I get 4,000. Oh, I'm getting off here. So yeah, 4,600 and $73.80.